Hey guys, Justin here again from Simplified Investing. I wanted to put together this video to teach some of you guys options trading in less than 10 minutes. Before we get into it, if you could like and subscribe to our channel, it would be greatly appreciated. We are still doing that huge 1K giveaway as soon as we reach 1,000 subscribers. So I will be going through this on the Thinkorswim platform. You can use this on Robinhood or whatever Webull, whatever platform you'd like. But I'll just give you the gist of options on the Thinkorswim platform, and the gist of the options will apply to those other two platforms. So, starting off, you will have a ticker or an underlying that you'll be trading options on. Options are basically going to be a leveraged or derivative tool on the market to provide you a greater return. With that becomes more risk, but also more reward. One contract is going to be equal to 100 shares of the company, and I'll show you the pricing for an option contract. So you see all of these prices here. So we'll go, this one for example is going to be, the bid is $1.06 and the ask is $1.08. What I like to do to get filled is add a study called the mark. This is going to be the difference between the bid and ask and the price you can get filled at. So if you see this 1.07 here, this is not $1.07 to purchase this contract. It will be $107 to purchase this contract. And then this may look like a lot at the beginning, but I'll break it down slowly for you guys. All of this right here, these are going to be the expiration dates when your option contract expires. The longer time frame that you get, so this 21st of January 2020, you can see that these are going to be very, very expensive simply because you have so much time on these option contracts to reach this price. So again, guys, the farther you go out, the more expensive the contracts are. Then you can go down here, and in simple terms, you see calls versus puts. Calls are going to be if you think the stock will go up, and puts are going to be if you think that the stock will go down. Now, to go into that, you can see the calls will be on this side. See calls right here, and puts over here. Again, puts if you think it's going to go down, and calls if you think the stock price is going to go up. So now you see all these different strikes right here. This is going to be the price that you expect the underlying to reach. So GLID in this case would reach $80 by this expiration. And as you can tell, if the stock price for calls on this side is already greater than the strike price here, they are going to be in the money, hence they're in blue, and they are going to be more expensive because the chance of these contracts finishing in the money or in this blue area is going to be a lot greater than, say, if you purchase this 115 contract out here, that takes a huge move in GLID to move into the money. That brings up the next point, dealing with these option contracts. When you trade out of the money contracts, these are going to be more risky and going to be more volatile than if you do trade these ones in the money. So if you're going to get your feet wet with options trading, trading in the money will provide you less volatility and less reward, but will ultimately get your feet wet into these option contracts and ultimately trading those contracts. So you can see on this side too here, you can see the price of the puts are going to be the same way, just in the opposite direction of the calls here for that price. And then the next thing that I wanted to talk about on Thinkorswim platform, strikes here, there are going to be several different strikes. You can see all of these strikes. Look how expensive these are. If you trade really far in the money here, especially on small cap stocks, it is going to be hard to get filled because they don't offer the liquidity that is needed. So when you purchase a contract, someone else must be selling a contract. And as you guys can tell from our channel, we trade primarily large cap stocks because of this reason. You don't have to worry about the liquidity issue when you're trading things like Apple, Netflix, Boeing, all of those. There's always going to be a seller and a buyer at the same time if you're trading at the money or within 5 or 10 out the money or in the money. And that's another question here. This option contract is going to be at the money, and then in this blue right here, that's going to be in the money. Again, those are less risky, less reward, and then black is going to be out of the money here, more risk and potentially more reward. So now the next thing that I will discuss in an important, really important aspect into options trading is going to be this percent right here, this implied volatility. Basically what this means is how expensive these contracts are relative to normal, and pretty much essentially you can think of this as, does the market see a big move in this stock? And you can see right here 100%, almost 100% implied volatility means that these contracts are really, really expensive. And as you can tell, GILD moved 9.73%. And what this implied volatility means is these contracts are more expensive than they normally are because the market anticipates a bigger move. So what I typically look for are things less than 50% implied volatility because they are going to be cheaper contracts. And when you have movement on the underlying, the premiums or the prices of these option contracts will move more than, say, if it had a extremely high premium and it moved a little bit. And that also brings in another point. People ask me like, hey, Justin, I bought this option contract, a call option, the stock went up, how come my price, my option didn't go up? This is going to be the biggest reason right here. Tesla's a great example of this. Tesla's IV is almost always at 200% recently, which basically means you're going to have to see a 4 to 5% move in Tesla if you're holding overnight to see that option contract actually move your way and increase in price. So that's one reason why you got to be careful with IV. A lot of people start out and don't really know what IV is, and that's why it is so important to understand this, because you can have a stock and predict the right movement, but if you have this really high IV, your option contract is not going to move the way you like, and ultimately your position will end up losing even though, say, Tesla or GILD moved in your way. So this is something too that you have to be careful with. The next thing that I really stress to people, especially if you're swing trading, these option contracts will have something called theta, which means that it's time decay. So when you're swing trading contracts, especially in the last month until expiration, these contracts will have the greatest time decay on the value. So if you're swinging this right here, these will lose value overnight simply just by holding them. That's part of the option contract. It's part of options trading. It's also part of the reason why you have to play swing trades light, especially going into the last week. So you can see this right here expires on April 24th of 2020, which will be this coming Friday. These contracts will have really high theta, and essentially meaning, say you bought calls here and GLID opened flat the next day or down even, and you had these call options, it's going to eat premium on these contracts. It's just part of options trading. It's part of the reason why I recommend for people to swing trade at least a month out. And the thing with swing trading a month out, you are also buying time. So if you buy a contract here that expires this week, you only have 6 days for the stock price to reach that price, this strike price right here. And if you purchase, say, a month out, or 2 months out, whatever it might be, you have longer time. Yeah, it's more expensive, but you have more time for the underlying to make a move to that position and ultimately a greater chance at profiting. So again, theta is going to be the highest in the last 30 days. So what I recommend people doing is swing trading at least 30 days out of the money, or not 30 days out, 30 days until expiration. And this will greatly help you with that problem of having time decay working against you. So not only do you have to hold a position overnight, you have that time working against you, but you also have theta. So again, it's always going to be smart to play contracts that are going to be farther out if you do plan on swing trading. One last thing that I want to show you guys or make a point of is going to be the IV here, so you can see how expensive these contracts are. We already discussed IV, but this is just a perfect example here of how much cheaper these contracts are for the 21st of August versus how expensive these are here and these are here. The longer the time frame you go out on expiration or contracts, they won't move as much until you get closer to the expiration, but they do provide a cheaper value, especially with GILD right now. You can see this contract, or this month's contract right here is 52% compared to 94% and 111%. Those contracts will be less likely. We can open one up, for example, even on the 15th of May. You can see that the percent change for this week's expiration was 500 and some %. but you can see that the percent change over here is going to be 100, 123. If you are looking to play longer term, they are going to be less volatile too as well. You can see these contracts lost 60% versus 20 and 30%. That's another reason why swing trading way out of the money or way out for expiration is going to ultimately help you reduce risk as well. One thing that I preach to members, if you are swinging the same week's expiration, to play light. You can see how rapid this movement is here. If you had this 79.5 put, you put your entire account value into this, you could be down 87.66%. It goes on hindsight too to the other side. You could have purchased this, say 110 call here and been up 660%. These are something that are going to move really rapid on the day or the week of the expiration. So if you are one that typically likes to hold these same week expiration contracts, make sure A, you play light, or B, you have a hedge on both sides, ultimately practicing proper account management and ultimately greatly increasing your chances of becoming profitable when swing trading or day trading these option contracts. So if this video helped you guys understand options some more, please give it a like and subscribe. As always, if you have any questions, comments, or concerns, post them down below and we'll be more than willing to help out or answer whatever you may need. As always, if you could head to simplifiedinvesting.site and check out our team. We do feature a private course where we go more in depth about this. We offer daily buy-sell alerts of what we are trading, and you also have one-on-one availability with myself. If you need any questions, have any problems, or want to speak directly to me, I am available to do that for you. It is also currently still 20% off for $99.99 monthly. There is no cancellation fee, and you can cancel anytime. If you guys could check that out, it would be greatly appreciated. Hope you guys all have an amazing weekend, and stay tuned for our weekly trade watch list tomorrow. Last week, several of those plays on our watch list ended up paying off big, so if you could stay tuned for that, you guys have potential plays that you could put in Monday. Hope you guys have an amazing weekend again, and as always, thanks for everything.